Hey everybody, Smart Silver Stacker here. Hope you're doing well. We need to talk about gold because there are factors at work in the world right now, this very moment, that have major implications for the precious metals markets. You may have noticed that just as the past week closed out, both gold and silver were making big moves, with silver up more than 4% in the Friday session and gold rising more than 3%. Now, we can talk about the factors that are driving the current moves in gold and also in silver, factors such as the nascent World War III that we seem to be on the cusp of, a global conflict that will almost certainly lead to higher inflation, rising commodity prices, and of course, lots and lots of money printing. After all, JP Morgan CEO Jamie Dimon just warned on Friday that we are living through the most dangerous time for the world in decades. The U.S. national debt is absolutely out of control, banks are becoming insolvent, interest rates are rising with no sign of stopping, and we are running the largest peacetime fiscal deficits ever, with no end in sight. And gold, well, gold is a safe haven. So there's a lot of factors that will be pushing the gold price much higher. But today, I want to go over with you not so much why gold is going to be moving higher, but just how high might it go. And I've teamed up with today's video sponsor, GoldMining Inc., ticker symbol GLDG, to share with you some of the ways that I plan to position myself to weather the coming storm. More on them later. As always, standard disclaimer here, folks, I am not a financial advisor, so nothing in this video should be interpreted as financial advice. But if you want my thoughts on just how high the gold price may go from these levels, let's examine this long-term chart of the price of gold. And as you can see, I have got a pattern drawn out here on this chart. And this is a cup and handle pattern that has been forming in the gold price for some time now. This is a very bullish chart pattern, and there are some things that we can learn from it about where the gold price is headed. And we will come right back to this chart, but first we need to take a look at this example of a cup and handle chart pattern from Investopedia. And the first thing you might say to yourself when you see this example is, isn't the handle portion of the pattern supposed to be sloped downward? Because when we go back and look at our chart of the gold price, you can see that that is actually not the case. The handle here is just moving sideways. Well, check this out. This is the inflation-adjusted gold price chart from macrotrends.net, and you can see that when we account for the declining value of the dollar that we are measuring gold's price in, there actually is a downward slope to the handle, just like in this classic cup and handle pattern setup. But the most important thing to keep an eye on here with this chart pattern is gold breaking out from the handle as we have here in this example, because you can see once that happens, the price tends to move much higher. And going back to our gold price chart here, you can see that we have tested this line 3 times now. And here's why this chart is so bullish. If we see the price of gold break through this level, right around $2,100, we will likely see it take off to new all-time highs. And according to Investopedia, a profit target with a cup and handle formation is arrived at by measuring the distance between the bottom of the cup, so down here, to the breakout level up here, and extending that distance upward from the breakout. So that being the case, to determine our target gold price, we would measure the distance from up here, $2,100, the peak, to the trough, which is around $1,050. So we do that. That gives us the difference, which is $1,050, and then we add that to the breakout level. So we add that to $2,100, and that gives us a price target of roughly $3,150. Now, to me, the thing that makes this price target particularly interesting is that back on January 21st of 1980, gold closed at $850 an ounce. And the reason that this date is so critical is that this is actually still gold's all-time high when you adjust it for inflation. Because if we adjust $850 in January of 1980 using this handy inflation calculator from the Bureau of Labor Statistics, you can see that we get a price of $3,362.73 in today's dollars. So this is awfully close to our price target from our cup and handle pattern. This is why I am convinced that in the next precious metals bull market, gold will be heading much higher, likely north of $3,000. And this is an event which, given the surging levels of debts and deficits, along with the worsening global geopolitical instability that we're witnessing, in my opinion, this will be taking place sooner rather than later. And my primary means of preparing for this move has been to stack physical gold and silver bullion. But one thing I've spoken about in the past is the barbell approach to investing, and this is outlined by Black Swan author Nassim Taleb in his other seminal work, Anti-Fragile. And the basic idea of this approach is that in order to insulate oneself from shocks, you put 90% of investable assets in a portfolio into very safe assets. And for me, when it comes to precious metals, that means physical bullion that is in my custody. But the other 10% of the barbell can be put into much riskier assets, and that is in order to give oneself exposure to enhanced upside potential. Now, when it comes to the precious metals, gold and silver, the higher risk assets with the potential to outperform the price of the metals themselves would be the miners. And the junior miners would be the riskiest assets of all. Of course, along with that comes the greatest potential for outsized returns. And to demonstrate just how outsized those returns can be, we need to come back to this gold price chart. And I want to examine two periods on this chart. The first one from late 2015, when gold was down around $1,050, to mid 2016, when it ran to over $1,300. And then also I want to take a look at this period from September of 2018, when gold was down under $1,200 again, to 2020, when it ran up the first time we were testing this 2100 level. Now, what I've just added onto this chart, I've superimposed it over the price of gold itself, which is still represented in the candles there, is this orange line, which represents the performance of GLDG, GoldMining Inc. And you can see that during those two significant runs up in the price of gold, the price of GLDG moved significantly more than the price of gold itself. Now, similarly, on the downside, the stock moves down faster than gold as well. This is the additional risk. So basically, assets like this, they give you a form of leverage to the price performance of the underlying metal. And it's important to note that there are risks with miners that don't exist with holding the metals. These are businesses. There is counterparty risk, there is management risk, there is geographical risk, but along with that additional risk comes a higher potential for return. When it comes to that geographical risk, GoldMining Inc. does have some things going for it. GoldMining Inc. holds a diversified portfolio of projects throughout the Americas, operating sites in the US, Canada, Colombia, Peru, and Brazil. So at least some of the geographical risk is diminished by not holding all the eggs in one basket, so to speak. And another reason that I like GoldMining Inc. is that in many ways it is a value play at its heart. The total cost of acquiring their portfolio of projects was a mere $81 million, and that is compared to a peak market cap of these assets of more than $850 million. And if you consider the assets that GoldMining Inc. is sitting on compared to how investors are valuing it, the numbers are actually pretty amazing, because right now the market cap for GoldMining Inc. is only $139 million. Take away the $20 million in cash that they're sitting on, along with 20 million shares of Gold Royalty Corp that they own, which are currently worth over $26 million, and that leaves you with a $93 million valuation that investors are placing on the company's remaining assets, which includes more than 16 million gold ounces equivalent of measured and indicated metal reserves. So when you buy GoldMining Inc., it's like paying about $5.80 per ounce of gold that they have in the ground. You can compare that to an industry average that's closer to $30 an ounce. This is likely why analysts from H.C. Wainwright & Co. have assigned a price target of $5.25 per share to GoldMining Inc. compared to today's price of just over 80 cents. And again, this is all why a stock like GLDG offers significantly more upside exposure to the price of gold than simply holding physical metal itself. One final reason I think GoldMining Inc. is worth taking a look at is this chart of the total gold reserves of some of the largest mining companies in operation. You can see that reserves have been on the decline for more than a decade, and as these large established miners continue to deplete their existing reserves, this industry will likely consolidate as the big miners will be looking for acquisitions to replenish those reserves, and a buyout by a large miner would likely mean a significant reward for GLDG shareholders. So for me, I like assets like GLDG that fit the barbell approach, and I believe that they complement stacking physical metals very nicely. But a word of caution, folks. Miners are not for everybody. There is an elevated level of risk. So certainly don't go out and buy this company just because you heard me talk about it here. Make sure that you do your own due diligence. A good place to start is by visiting goldmining.com, where you can find more information about this company. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker